Good morning all. Thank you for joining us for this BIA webinar on seed funding and on the relationship between investors and the CEO. I've got quite an all-star cast lined up today for this webinar. My name is Sam Cruikshank. I'm the program manager at the BIA. So what I'll do is I'll briefly introduce everyone, explain who they are and who their organisation is. We'll then quickly run through the relationship between them because some of them will be presenting together, and then I'll move on to Steve to give an introduction to the webinar and to walk through what the BIA has been up to recently, followed by a number of case studies from our guests. So to start with, we have Steve Bates, who, as I'm sure many of you will know, is the CEO of the BIA. Then we have Bernardo Bizzini, who is an investment analyst at Investiere, and Henrik Hagemann of Puraffinity. So Henrik is the CEO. Investiere has invested in Puraffinity, and so they will be here to kind of give a case study on how they found each other, how they decided to work together, and what they were looking for in a partner when they did that. And hopefully there'll be some useful information to take away from that. This will be followed by Ruth McKernan, who is a venture partner at the Dementia Discovery Fund and also the chair of the BIA, and David Reynolds, who is the CEO of AstronauTx. So AstronauTx was launched by the DDF and has been funded by them. So they will be talking a bit about that process, and David will share some thoughts of his from being a first-time CEO. And then finally, we'll have Antoine Espinet, who is the CEO of MicrofluidX, and he'll share his own experiences of finding seed funding, and he'll then present some lessons learned and a couple of mistakes made during the process, and hopefully that will be informative to other people going through the same process. And then we'll finally finish up with time for Q&A. So please do enter any questions you have in the questions box, which should be appearing on your screen, and we will do our best to answer as many of those as we can. So on to Steve.
Morning, everybody. Thank you, Sam. I'm Steve Bates. I'm the CEO of the BIA, and let's put this event in context. I mean, we would normally at this time of the year be doing regional events and going around the country and looking at themes. The agenda today largely comes from stuff that we would have done at a London breakfast, but delighted it can now be for the whole country. And I suppose it's in the element of helping younger companies understand the process. And there are many things that are odd at the moment about the environment, but one of the things that's fundamental to successfully building a company is the relationship between investor and CEO. And we thought it was such a useful topic, building on some of the discussion that we'd had at Pulse with the Crick earlier in the year, that this is something that wherever you're at in the journey is always useful to hear from. We had such a great panel lined up. We thought we would virtualize it and make it for you this week. So if you're used to sort of me talking about COVID for a lot, we will do that on Thursday, but really this is more business as usual from the BIA and focusing on what I think is a really, really important aspect of this. But for those of you who are not used to the BIA, next slide, please. I'm just going to run through very quickly what we've been doing, what we've been up to, as we would do normally at a BIA event. If you've not been to a BIA event before, who are we? We're the Trade Association for Innovative Life Science Companies. We do three basic things: we influence, we connect, and we save. At the moment, we're doing quite a lot of influence around making sure our members' voices are heard on important things, and I'll touch on that. We connect through events. Obviously, at the moment, those events are virtual, but often they are face-to-face, and I think you'll get a lot out of the discussion that we're going to have in the next part of this event. And for companies that are building lab-based companies and other things, we have a business solutions scheme that can save you money on purchases. We get together in advisory committees and lots of other things, but we're a really vibrant community. And the strength of the association is its members, and it's great that we've got so many members who are sharing their experience with you today. Next slide. So what have we been doing? Well, to be honest, this quarter it's largely been COVID-19 stuff, and on the left-hand side here you can see the microsite set up on the BIA website with action and guidance on COVID-19. That's our sort of living brain of activity that we think is useful for members. Obviously, in the influence side of things, we've worked very closely to support the development of a vaccine manufacturing task force, which was taken up by the government on Friday. And it's fantastic to see many members engaged in supporting the development of vaccine manufacture for COVID-19. And that's a really vibrant program, which has got great work going on for it. We've also made sure that we've called for a support package to lessen the impact of the virus for companies within our sector. We call them knowledge economy companies, and you've seen only yesterday the Chancellor announced a £1.25 billion plan to help struggling UK startups. I wouldn't consider them all to be struggling, but I think great companies working in a very difficult and challenging environment where some of the package that had been announced previously wouldn't fit for the types of companies we've got. It's great to see that coming out. And next slide, please. So I suppose, as I say, we've deep dived into COVID-19. We've worked very hard on testing, and BIA member Thermo Fisher have been at the heart of the scaling up of the mega labs. As you've seen, many companies have donated kits or made sure consumables are available to that scheme, which has rapidly increased UK's capability in this. And we've also worked with the government to try and make sure that there are better ways in for companies to engage and a clear understanding of the detailed plan of what the government want, how they want to work, and how they want to work with companies, and exemplified here by the middle guidance from the government. And then I've worked with BIVDA and the Royal College of Pathology, as well as the department, on crowdsourcing platforms on particular challenges within the testing environment that they're looking to improve practice on rapidly. And it's been great to see 4 or 5 things be rapidly adopted into practice in the last week, with new bulletins coming out to improve throughput in labs. Next slide. So this may be what you're thinking I was going to talk a lot about. I'm not going to talk a lot about the COVID-19 financial support package announced yesterday, trailed in newscast details on the BIA microsite. We're largely going to talk about this on a webinar on Thursday morning. So if you want more on this, it's Thursday morning, but the headlines are: there's a new future fund to provide convertible loans for businesses that can raise money from private investors at the same time to enable you to get a new round away if you're in a venture financing round environment, which I think is something that's very positive, and we're diving into the detail of that. And there's also a significant new scheme from Innovate UK, which will get more flesh on the bones on this week, which, if you're used to applying for schemes through Innovate UK, I think will also be a significant way for companies to access capital, do new projects in the coming months. So I think a combination of future fund through the BBB, enabling them to come alongside investors as they come into future rounds, and support from Innovate are two really useful new schemes that weren't available at the weekend, that we'll be able to demonstrate more detail of on Thursday, and will be open very soon. Of course, the devil will be in the detail and the implementation, and we'll be working with members on both of those. I think that was it from me. Sam, am I right?
Yeah, I think that's all from Steve. So yeah, thank you, Steve. Thanks for sharing that. We're now going to go to Bernardo and Henrik, who will be talking about their kind of investor-CEO relationship and how they came to work together. Thank you both for joining us. We really appreciate you giving up your time. It's quite a busy time at the moment, so thank you both for doing that. And I'll hand over to you.
Great. Yeah. So thank you all for joining. We're going to just go through some of these slides where, yeah, the outline of this is basically focused around Puraffinity. So Puraffinity had a fundraise in 2019 with a close. The 3 institutional investors that joined us was Bernardo representing Investiere, was Kindred Capital from the UK, and then Heritage Group Ventures from the US. So we had quite an international round. We're going to try and talk about how that round came about. First going through the introductions, and then yeah, we can talk about the round itself. So me, I'm Henrik. I'm the CEO and founder of Puraffinity. At Puraffinity, we engineer bio-based materials to capture chemicals in water. At the time of the fundraise, we were pre-revenue. We had lab pilots with superior performance data with client water. Before the fundraise, we had raised £1.6 million grants, and we were 8 full-time employees at that time.
Bernardo, your microphone is still muted.
Yeah. Can you hear me?
Oh, yeah.
Yeah. So hi together. Good morning. My name is Bernardo. I'm part of the investment team of Investiere. As Henrik mentioned, we are a Swiss-based fund and founded in 2010, and currently operate in 4 offices in Switzerland, Germany, and France, and have a focus on technology startups across Europe. Annually, we invest around 30 to 40 million pounds across all sectors and accumulated over the years over 70 portfolio companies, executed over 100 financing rounds.
Great. And then what we're going to try and dive into is the financing round itself. So the financing round was basically kicked off in October 2018. Just in September, we were preparing all the work, and then we had this first close in March and a final close in July. And basically, you can see here the timeline from both sides. From our side, it was about designing a process. So very much thinking about this like an enterprise sale and thinking about, okay, what does the top line pipeline need to look like in order to go through this process with the first term sheet then coming in just in the end of November, beginning of December, and then building a syndicate to then have international investors, which was really part of our goal here, with a final close of that process then in July 2019.
Yeah, and maybe now from an investor perspective, we are usually like doing screening, but also evaluating. So there's several projects going on for an investor. From startup, it's only one. So it obviously started for us in the screening phase. I will talk a little bit more about that in the next slide. But then obviously after first contact where I reached out to Henrik over LinkedIn, and in October 2018, we requested a pitch deck for further analysis, and then also shortly after entered into the pre-evaluation phase as we required a lead investor to move forward, and this was quite quickly identified with Kindred. And by the end of 2018, we then entered into the due diligence stage, where we looked deeper into the materials that were prepared by Puraffinity, and also had Henrik coming over to Zurich for a pitch. And yeah, so by the end of February, we had the positive IC decision to move forward with investment, which is roughly 5 months after the first contact, which is, yeah, seemingly a little bit long, but it's just the time it takes sometimes. And also personally, Puraffinity is a special case to me because I actually joined investiere in 2018 in October, and this was the first case that I brought from screening to the full investment. So this was, yeah, on a personal note, also special to me.
Yeah, that's often left out, but it is like a personal process. We are working with people. Let's go through to the next slide. Just make sure. So we will have a look at the. Sorry, one too far, one back. We'll have a look at the fundraising kickoff. Basically, make sure. Sorry, just one. Back to slide 4 here. Let me make sure we get there. I'll talk. So basically, we were looking as Puraffinity for a deep tech investor with sector experience, and we're looking for someone with experience in biotech and in sustainability. Just this slide just before this. And basically, what we're also trying to find, which is hard in the financing space, is basically someone with operational experience among the team. So oftentimes we started out by making a large list of potential investors, and then before going to contact them, we started knocking ones out that we wanted to deprioritize because they didn't fulfill these 2 first screening criteria from our side. Then we also had another screening criteria of this sort of some element of a patient capital approach. So for Heritage Group, they have an evergreen fund. For Kindred Capital, they were in the beginning of the new fund, so they had 10-year timelines. And for Verve Investiere, we basically had this unique LP structure where each investee basically corresponds to a fund of its own vintage. So for each one of these potential funds, we basically looked at, did they have an element of this patient capital piece? And then we went through this diligence process, and during diligence, what we were looking for, as well as providing the material to the investor, is also how does the references on the investor work out? So we looked at trying to get positive, well, in this case, we got positive and supportive portfolio founder references. We got deep involved with Romeo and Bernardo and got impressed with their grasp of the technology, but also the upside potential. And then when I went to Zurich and we really dug behind the scenes to meet some of the LPs, it was this element of being impressed by their operational experience. They're not just financiers. They actually had some building company experience that could add value to Puraffinity longer term. And so those are some of the, those were the key drivers for why we wanted to collaborate on this piece.
Maybe from the investor side, we actually identified Puraffinity on the EIT Health website, where many clean tech startups are listed. We probably screened over 100 companies there and selected a few to contact, which also included Puraffinity. And the reasons were mainly that the combination between the then seemingly strong technology and the target of the PFAS market, which is a very big market, but rather like overlooked. So we found that combination very interesting, and also coming out from a solid lab and research, which was one of our overall investment criteria. But as I mentioned, or as you know, Puraffinity is a UK company, as we are Swiss-based, we require the lead investor to move forwards. Then into the pre-evaluation phase, we were especially impressed by Henrik's passion about the technology, but also his deep knowledge and understanding, which was very unique. And also, I want to highlight the materials handed over by Henrik. So the data room were very, very high quality. They have very good data and made it for us very easy to understand the rather complex and difficult topic of PFAS purification. And also, lastly, our exchange with Kindred, so the lead investor, where we kind of use as a sparring partner to validate our investment rationale, and made the case very round, although it was also very early for us and we identified several yellow flags, but we still decided to move forward into the technical due diligence phase. There we mainly talk with reference experts, on the one hand provided by Henrik, but also from our own network, and we kind of try to triangulate all views and points raised, and focus especially on the competitors, because the market is very big, but there are a few players also trying to solve one of the hardest problems on this earth. So, but the technological advantage of Puraffinity and also the approach and scalability of the product made us really outweigh the risks and against benefits, and we decided for us to move forward.
Great. And then, do you want to
maybe for the key takeaways from our view, I think that it's important to present the company from the best side, but also without exaggeration, because investors look at a lot of pitch decks and we kind of feel when something is exaggerated or not, and we rather we enjoy it when also things are highlighted that are not so good, or maybe risks that are not so obvious. So I think on one hand, perception is very important to have all the documentation up to date and very neat and clean, and also with high content, high quality content, and also transparency about the pitfalls and risks, which Henrik was always very open about and communicated, and investors know that, and that's the gamble investors to take. So having there an open communication is very important. And also to connect investors during the syndication process helps to kind of de-risk the investment, because one can exchange what one thinks is a risk and what other things, and sometimes this misperceptions or risks identified can be identified as not really a risk.
Yeah, and then I guess from the, let's say, investee side, from the portfolio company side, we wanted to highlight 2 points. So one of them is around the process. So you, as an investor or as a potential portfolio company, you really want to have a laid out process where the different parties are stakeholder managed. They want to know what the other investors are doing at any given point. They want to know where you are moving as a company, that you have cash runway to go through this process, and you actually have prepared for that in advance. So basically, I would suggest to design a pre-arranged process with timelines, expectations for each stage, and clear cutoff points. And basically, if you've heard about this concept before, treat it as an enterprise sale. So you have to have a pipeline, you have to understand how different players move through that pipeline, and you need to like prioritize your time all the time. So for the fifth point, it is a tool for prioritizing your time. So you want to do as much diligence on the investor as they do on you, and that you want to use to inform how you spend your time. So if the founder references are lukewarm or they're bringing up red flags, then it's like, oh, stop prioritizing that potential investor in terms of how you allocate your time. If the founder references show up really positive, and they've had, they even let you talk to some of their founders who didn't work out one-to-one without them there, and it's still positive, then it's like, okay, really prioritize those investors and help use that as a tool to inform how you spend your time. Yeah, so that was all from our side in the first round.
Yeah, thank you both so much for that presentation. It was really, really helpful, and yeah, I'm sure a lot of people watching will have gotten a huge amount from it. So thank you. We're now going to move over to Ruth and David, who will talk about the DDF and AstronauTx. Thank you both.
Okay, good morning. So I'm going to talk about the relationship from the investor perspective, and I'm a venture partner with the Dementia Discovery Fund. The Dementia Discovery Fund is a specialist fund, really only makes investments in therapeutics in the area of dementia, so very narrow, and it's managed by SV Health Managers. The interesting thing about the Dementia Discovery Fund, as a neuroscientist myself, is that it was really put in place to start creating alternative therapeutics for dementia, an area that is incredibly difficult to treat. And the investors for the DDF came from many different places. So pharmaceutical companies, Gates, all over the place really. And it has a slightly more patient approach than some other funds. The other thing I think that sets it apart is, as well as funding existing companies, we also create companies. Of the 16 investments that have been made so far, about a third of those are companies that have been created in partnership with the DDF. Now, what matters to the DDF as an investor is the science, the team, the business plan, and the dynamics. And I'll talk about all of these in turn. The first thing to say, though, is the investor-CEO relationship begins at the very first meeting, long before any checks have been written or any diligence has been done. And particularly when companies are being created, the investment team, the venture partners, everybody in the DDF is already on the lookout with their antennae up for who are leaders in the field. If we're able to stand up a company, who would be a good person to be a CEO? Because very often when we create companies, the idea may be there, the science may be there, but the leadership won't be there. So as we look at companies, the first thing very clearly is the science. It has to be ideally an area of science that is not really well invested in already, something novel and exciting. There's nothing investors like more than being the first person to see a novel idea that they can invest in and see a path through to creating value. We work quite a lot actually with academic organisations and with research charities. So a couple of the companies that we founded, the science has come from an academic group and quite often funded by a charity, and David may speak to that a little bit more. But the science is absolutely the first thing, and as we're putting a company together or investing in a company, that is critical. The relationship begins not just with the CEO but with the team, particularly if you're creating a company. The scientists who've created the work, do they want to try and run the company themselves? I would say largely this does not work out well, but you do want them on your scientific advisory board, and you do want them to be close to the company all the way through, because science evolves. You want the company to be absolutely at the cutting edge. You want to invest in the best, the fast growing, the leading companies. And the advisory board is really critical when setting up a company. Who are the leaders in the field? Are they on your team or are they on somebody else's team? This is important. The third part is the business plan. So it's the same challenge, I would say, in raising funding if you're an existing company from creating a company, in that you have to be really realistic about the business plan. Having spent 27 years in pharma, I've come to realise that things do cost twice as much and take twice as long as you think they're going to. So the relationship with the CEO and the team really builds around, are they being realistic about what can be delivered and how much it will cost? How much funds will need to be garnered at each stage? How can you work with this team to raise additional money? Which other investors are likely to want to be part of this growing business? And then ultimately, do you agree? Is there consensus on the exit? Should it be directed at a pharma company? Should it be directed at an IPO? All of these are very important points. And my last point here is the dynamics. The relationship with the CEO, the advisory group, and the team goes through all of this, from the very initial conversation through that complex due diligence and investment process that was so nicely outlined in the previous presentation, all the way to the company actually starts. You have to hire people. Somebody from the investment organization will sit on the board. The dynamics continue all the way through, and having a really strong working relationship with the CEO is probably the most important thing that an investor needs. Together, you can solve problems. Together, you can find more money. Together, you can pivot the company. But if there isn't alignment, I think that is where the trouble starts. And so maintaining a really strong and healthy relationship with the CEO all the way through is really important. And I think this is the point at which I hand over to David, who is the CEO of AstronauTx, one of the companies that I've been quite close to in its inception. And David can talk to it from the other side of the fence.
Thank you, Ruth. So I joined the DDF, or was hired by the DDF just over a year ago, and I was brought in to lead two companies they were in the process of creating. One's called AstronauTx and the other is Locus 23 Therapeutics. AstronauTx is a company focusing on the role of astrocytes, one of the main support cells in the brain, and how modulating their function can be used to improve the symptoms and the long-term disease progression in Alzheimer's disease and likely other neurodegenerative dementia-causing diseases. Locus 23 is a different proposition focused on Huntington's disease and leveraging what we've learned about the importance of DNA damage repair mechanisms in this disease and driving pathology. So those are the two companies I spend my time leading. And I guess the question is, what kind of skills and experience do I have that allow me to be hired in to do this job? And what challenges have I faced in my first year as a CEO of not one, but two companies? So my experience is about 20 years in large pharma doing drug discovery all the way from kind of exploratory stages through to phase 2 clinical trials, with some appreciation of what the later stage development and things like the payer landscape is like for bringing forward new neuroscience therapeutics. And that is absolutely invaluable in understanding what we're trying to do and building the business plan, but also thinking from the funding, the fundraising side of things and the exit, what value are we trying to create in the company? What things do we need to think about very early in drug discovery that won't necessarily play out until you get to the clinic or some consideration for the market, but you've got to think all the way back. And then the other key piece of experience I had, and actually was the segue into meeting people at SV and the DDF, was I spent 3 years as the Chief Scientist at Alzheimer's Research UK, which was a former charity partner of the BIA. Now, AI UK funds dementia research across the UK, about £20 million a year research budget. And it does the classic kind of charity academic grants, but very importantly, it also recognised the need in this area particularly for more translational work and set up, amongst other things, a drug discovery alliance where there were expert groups of drug discoverers embedded in UCL, Oxford and Cambridge universities, And there the idea was to take a kind of great nature paper and kick the tires on it as a target to find potent and selective molecules that says this could be a good drug target, and importantly, make it investable. And that's where AstronauTx came from, because AstronauTx was founded with a program from the UCL Drug Discovery Institute, led by Paul Whiting. They had put together a package of data that said the target looked attractive, it modulated astrocytes and had beneficial effects, at least in animal models, for treating Alzheimer's disease. And therefore we, informing AstronauTx, did a deal with UCL so that we can work with them under a sponsored agreement to move the chemistry and the biology forward. And then other skills that they don't have within the institute, such as the ADME or safety skills, we outsource to CROs. And that's how the company's been running for the last year. Things are going very well, and I'm hoping that we'll be able to nominate a candidate about this time next year and raise a Series A to get us through into the clinic. Now, the things I've learned over the last year, well, that could take a whole seminar in itself. I think the key things I've appreciated is that drug discovery in biotech has some similarities to that in pharma, but there are an awful lot of differences. And one of the things I really did very early on is make sure that I built those strong relationships with my funders, the DDF. And actually, we started life in the kind of back office of the DDF offices, which meant that I had daily access to the team, not just the investing partners, which helped me with the business plan and the fundraising side of things, but also other members of the team who've done company creation before. So what's all the stuff you need to set up in terms of having insurance, having a bank account, all the other stuff that when you're in a large company just magically seems to happen. But when you're in a company of 2 or 3 of you, you've got to put it together. And that was the other thing I realized very early on, that actually having a really skilled operational person in the team was really, really important. The science was critical, but actually if you didn't have the operations to go with it, then you weren't going to last very long as a company in terms of getting set up and running effectively. And then finally, the other thing that I really appreciated is that as a first-time CEO, I knew how to do drug discovery, but I hadn't done biotech business before. So I worked hard leveraging the contacts my investors had to find an independent board member who got a lot of experience, who can then help advise me separate from the investors themselves around the kind of the business side of biotech, so that I didn't make any schoolboy errors in getting the company set up and moving it forwards. So I think I'll stop there and hand back to Sam.
Thank you both for that. It was, yeah, really illuminating and really helpful to have both sides of that walk through by you. So yeah, thank you so much for your time. And I'm now going to hand over to our final speaker, who is Antoine Espinet, CEO of MicrofluidX. Thank you, Antoine.
Thank you very much, Sam. I'll try to man my own slides if that works. Oh, do I need to? Yeah, exactly. Cool. All right, so I'm Antoine. I'm a CEO of MicrofluidX. We raised our round of seed funding actually a couple of weeks ago. We closed our round a couple of weeks ago, so this is all very fresh. So just a few words about MicrofluidX. So we are a early stage startup in the business of developing platforms for process development and manufacturing for cell and gene therapies. And those platforms are leveraging the MicrofluidX technology. We incorporated in 2018, and we started our fundraising journey in January of 2019. Currently, we have 3 employees. We have some contractors and advisors around us. We are located at University of Hertfordshire, and we just closed our seed round, like I was saying, of 1.41 million. And we also have some grant funding from Innovate UK. So this is the fundraising journey. So the first thing you see is, people say it's usually 6 months to a year. It took us a little bit more than a year, so about 16 months. Like I said, we started in actually January 2019. Should be there on the slide, not 2020. So we started in January 2019. with our first investor conference, which was a BioSeed. And then in March 2019, again, we had our first meeting with investors. We realized that we actually needed more money because of this meeting. So we kind of were then looking for $500,000. In April, again, 2019, we had over 40 investors contacted, and we had gotten five investor meeting. So, you know, about a 10%, a little bit more than a 10% hit rate, which is not bad. The next month, we really ramped up the contacts. And by the way, there are databases that you can get where you have, you know, all the seed investors, life science seed investors in the UK. And we just kind of went down the list and sent an email to everybody, on top of obviously doing also other things. But in May, we had 80 people contacted. In June, we had 100 people contacted, and we had about a 20% hit rate in terms of getting at least one meeting. Finally, in August, so 8 months after starting this, so August 2019 again, we had our first term sheet. What helped really with getting the syndicate forms was that we got a Innovate UK grant in September, and that really, that together with the term sheet really accelerated the formation of the syndicate. And we quickly got a second and third venture capital firm interested, and we actually got very quickly oversubscribed. So both because some VCs were increasing the amounts that they were wanting to put in, usually to match other VCs that they want to be, let's say, they don't want to be left behind. So, but also then other investors also coming in, angel investors and other funds. So again, all the dates here should be 2019, except the last one, so April 2020. So this month, where we finally closed our legal. So what you can see as well is that it took a really long time to get the legals done. I mean, at least from my perspective. So we started negotiating in December, and it was we finished in April. And I think this was due to the fact that we had a big syndicate. So the investors that invested in MicrofluidX are UK I2S, which is managed by Midven, Longwall Ventures, which is a VC in Oxford, Molten Goodies, which is a family office in London, and the Cambridge Angels, as well as 88 Capital and some friends and family. So it was quite a big syndicate, and that's what part of the reason why it took so long to do this. Okay, so let's go to the next slide. Okay, so how did we find funds? I thought that would be a good thing to look at. So first and foremost, it was really personal network, and by personal network, I don't mean like for me, it wasn't an existing network, right? I moved to the UK a couple of years ago, didn't know anybody in the UK, didn't have a specific background in the UK life science ecosystem, so I didn't know really any of the players, any of the influencers. And so what I did was going to a lot of conferences, subject matter conferences, just kind of pitching my idea, not necessarily to investors, but just to people in general. And people kind of volunteered to, to introduce us to someone else that they knew, and then you just follow up. So you really kind of just follow up on the emails, go for coffees, and in a matter of, let's say, a year, the network that we had was very large, and we kind of knew everybody that at least knew someone in the field that could introduce us. So that was a really, really big one for us to raise the money. The second part that was investor conferences, so that helped. So I was mentioning BioSeed, but also went to BioCap in Manchester, the BIA investor conference. I think changed name now, but that was also last year in June. Biotrinity, which was last year in Spain. So a lot of investor conference. These are really good to meet investors that you wouldn't have otherwise met or be able to reach out to. So especially with these investor conferences, was the most powerful tool of the networking tools that is usually built in an app, and you can kind of set up meetings and meet investors. So that was also a big tool. The third one, which helped us connect to investors and also get a lot of visibility, was the accelerator programs. So the BIA Pulse, the Accelerate program at Babraham, the BioCity program in Nottingham. I think there are several other BioCity programs around the country. And so these programs were really key to give visibility. So, you know, there were a lot of press around this, but also a lot of investors came to these events and to these programs. You can make lots of connections there as well. Then I put grants because that was a good source of funding while we were looking for private funding. Innovate UK, there's also IP Audit Plus prize, which is managed by the EN. So in London, it's Newable, which gives you, I think, £2,000 to do some IP work, or £3,000 to do some IP work. There's also a grant managed by MedCity, Collaborate to Innovate. So all these grants together either gave us funding or really accelerated the trust that we got from investors and accelerated the investment. And so I mentioned some of these players, some of the organizations that can be really helpful for this. KTN, Knowledge Transfer Network, can reach out. The EN, so I mentioned Newable and MedCity. So you know, feel free to reach out to these people, and they will help you get set up. And then the last thing we use, which is a bit unusual for seed round, was also brokers. So brokers usually take a 5% fee on the funds that you raise, or the fund that they enable you to raise. So it's not necessarily on the whole amount, but we use that, and we're successful to a big chunk of our money came from brokers, and we found that quite useful. Next slide, please. All right, so first thing we did was to kind of structure our presentation and the way that we're communicating along some dimensions that were important to investors. So the team we found out to be quite important. The product market fit. So there is a science, but does anybody care? The technology, which is a science, the IP, so the protection of that, and the quality of the execution. So the ability for the team to execute. Let's go through the animation here and do the entire slide, because otherwise it's going to be hard to go through. So yeah, you can. So the first thing to see is that in January 2019, when we started the fundraising journey, honestly, you know, looking back, we weren't really investable at that time. Because of you know, we weren't ticking all the boxes, and to us, we found that ticking all these boxes was, you know, the minimum to be able to be investable. And so we worked quite hard to make the company investable over the course of last year. So in terms of the team, you know, recruiting advisors, senior advisors, people who really were experts in their field and had proven track record, completing the team with the skills that we required. Product market fit was a huge differentiator for us to the investors, which was to go out in the market and just reach out to everybody you could find on LinkedIn and through the network, and just interviewing them about the need on the market. So potential customers, providers, etc. Technology was okay, but we still invested some money to try to keep bringing some good news to investors about the technology and you know, validation of the technology. IP weren't really there. We had one patent pending at that time, but we did a lot in terms of FTO, landscape, IP landscape analysis, a lot of analysis, competitor analysis, etc. So on IP we did a lot of work. Partly thanks to the IP Audit Plus prize that we got. And the quality of execution, really, it's more something that just requires time. So it's about showing the investor that you are actually able to execute. And so you're never gonna get a meeting, a first meeting with an investor and get funding, right? So the investors want to see you kind of do your thing. They want to see you do what you say you will do and communicate on it. So we did a bunch of stuff, and at the end they were convinced that we could execute. Could go to the next slide. So maybe, yeah, go through the entire thing as well. Just so I think a few mistakes that we made was spending a little bit too much time and energy on investors either we didn't like from the beginning and were never, you know, we would want to have a relationship with in the long term, or investors who didn't like us and then we're kind of emailing them and trying to get a meeting with them and they didn't want to, or they would have one meeting and then they would go silent and we would keep chasing them. So that's really was a waste of time. I think some investors need convincing more than others, but in general, if you like them, you know, that's good. But also if they like you, you will kind of know it. So either they will try to coach you and help you to become investable, or they will you know, kind of move ahead with term sheets and stuff like this. But if they go silent and they're not interested, you know, you can send one reminder, but don't spend a lot of time and energy trying to secure investment in the first meeting. So I already mentioned this point. You never secure investment in the first meeting. You know, we would come out of the first meeting quite disappointed that we didn't get a term sheet out of it at the beginning. Basically, that doesn't work. You need to build the relationship. You need to kind of announce what you will do it, go back to the investor, say, look, I did what I said, get a second meeting, meet another partner, etc. So it takes a long time. Not having a strong local network of influencers. So initially we're just trying to cold email everybody, and we didn't understand who was basically speaking to whom, who was friends with whom. And so understanding, using the network and understanding how the network works was really key. Some investors, you know, don't like to work with each other. Some do. Some investors are friends with others and some don't. So it's really important to understand this, because that basically allows you to accelerate and not waste time. Not talking to the decision makers at investment firms, so that was also a mistake. So initially you usually get put in touch with an investment analyst, and you know, we work with really good investment analysts, and you know, they did a lot of great work together and got us to where we are today. But at some point, it's really important, I think, to start a relationship with a partner, because as you go into negotiations and as you go into decisions about different terms, really the partners is the one who is going to decide. And so if you only have a relationship with an analyst, you are going to have to wait every time for the analyst to go back to the partner and get the decision from a partner that you don't have a relationship with, doesn't know you, and then get the decision. It's a yes or no, you can't say anything. So that was really something that we would change on the next round. And lastly, waiting too long to disclose information. So, you know, we try, like been previously mentioned in the other presentation, we try to be very, you know, very open, but also present the company in the best way, especially at the beginning. But it's a bit like dating. I mean, if you live in your mom's basement, you have to say it at some point in the relationship. And if you say it too late, then you can lose the trust, or it will take a long time to get the trust back. And I think for us, you know, we waited too long for some of the stuff. You know, wasn't anything important or very important, but I think there was some investors were a bit surprised. Okay, like, why didn't you tell us this before? And you know, there's a bit of a fine line where, you know, you don't want to say too early, because you want to first, it might be confidential, but also you want to kind of present the company in the best light. But at some point, you do have to be transparent about the flags and the risks that you see, so that everybody's on the same page. And that will really accelerate the process afterwards. Okay, so maybe I think I'm a bit over my time, so maybe I'll stop here, Sam, unless there is more time.
We've got a little bit more time, so because the end of the webinar is 11:15, so you can okay. Go over a little bit, and we'll still have some time for questions at the end.
Okay, perfect. So kind of this is a process after we had kind of found our first investors who was willing to give us a term sheet. So we had to sign a term sheet, then form the syndicate or finish forming the syndicate, negotiate the finance documents and close the deal. So here are some tips around this. So first on signing the term sheet, I think a lot of, you can go back one slide. Yeah, so first on signing the term sheet, a lot of companies we saw around us were focusing a lot on valuation, but I just want to raise the point that also vesting, control, and good liver, bad liver provisions are really important to negotiate in the term sheet. So, you know, that's something that you really want to focus on. On valuation, is good. You know, obviously you don't want to undersell your company, but for a seed round, my opinion is that you shouldn't try to raise your valuation too high artificially, because that will create some problems later on where you have to show that you created some value and you have to show a higher valuation than before. And so on valuation, you know, you can be reasonable, you need to be reasonable, but don't push too much for the highest valuation, you know, ever possible, because that will bite you later on. In option pool, just a quick trick, quick tip on the option pool. So if you can put the option pool after the investment, so meaning that it's a post-completion option pool, then everybody gets diluted, the investors and you get diluted. If you put the option pool before the investors, only the founders will get diluted and the existing investors, if there are any, and then the new investors won't. So that's a quick trick that will reduce your dilution. And also a lot of investors we talk to use the BVCA standard, which is a template from the British Venture Capital Association. As the name states, this is a British Venture Capital Association, so this is investor friendly. So don't let people tell you that it is a standard template and that you need to accept it. There are some, it's a really good base, but it is investor friendly. Then forming the syndicate. So basically, once we had one term sheet from the investors, we had to find all the other investors to kind of close the round. So we went back to all the investors we had already contacted, and that was really helpful because once we had a term sheet, a lot of investors wanted to talk to us again and re-engage in conversation. We did get oversubscribed. That was when I did mention we were looking for 500,000 and we got 1.5. We had probably over 2 million of subscription. So if it doesn't become manageable in terms of your dilution at that time, try to ask for a higher valuation, because a higher valuation will essentially kind of minimize your dilution. So if you do get oversubscribed and your valuation doesn't make sense, your dilution doesn't make sense anymore, you can go back and say, okay, we need a high valuation to be able to take all the money, if you want to take more money than you initially thought. Creating a clean data room and only uploaded what is needed. So we made the mistake of kind of initially uploaded everything we had, and so basically that creates a lot of questions, that creates a lot of work for everybody. So when you create your data room, just put the documents that you need, and even wait for some documents to be requested and uploaded as is. Then negotiating the finance documents. So here are a few tips. So first, ask for a cap on the legals. Don't let your lawyer kind of start working. You need to get a cap up front. Same on the investor side if you can. Try to also get your syndicate to have only one lawyer, which facilitates the process immensely and accelerates the process immensely. If you can draft the document yourself. So if your lawyer can draft the document, then you will start from a better position, right? Because you will start from a founder position rather than investor position, which will get worse as you negotiate, but the starting point is better. So we did that, and I think it was a good thing for us. There are Also think that there are market standards, and so people, investors will tell you, yes, this is market standard, but actually you can be as creative as you want, right? So it's basically only what you can agree on that matters. It's not the market standard, and certainly the BVCA is a standard, but it's something that can be changed and can be adapted. Yeah, so and then closing the deal, I'll just skip to closing the deal where have all the documentation in good order. You share structure, if you had a share split, it needs to be done. You need to have your SEIS advanced insurance already done. Otherwise, you're going to waste another 5 weeks, 6 weeks, your bank account set up. And at the end, there are a lot of people who will have helped you, made introductions for you, talk to people for you. So really important to thank people and send a bottle of champagne to your lawyer. And everybody feels being grateful for the help that you've received, because you will get and you will need help. So my takeaway, if you can move to the next slide. My takeaway is putting all your chances on your side. So cultivating your network, being very diligent about following up, trying to get out, go for coffees, even if it doesn't feel like it's necessarily like an investor, or it doesn't feel like it's necessarily someone who can directly help you. People know people, and that's how we did it. Apply to programs and grants that helps you both financially in the meantime, but also while you are, to build trust among investors and to build recognition that you have a good project. And be coachable. So like I showed, we moved the company from a state of being non-investable to a state of being investable. And that was all thanks to investors giving us feedback. And sometimes the feedback is not that clear, but you kind of read between the lines. And so, going out there and taking the feedback, saying that you will do this and that, X and Y to implement that feedback, then actually do it, go back to the investor. That's been proven really powerful for us to secure the round. So thank you very much.
Thank you, Antoine. That was really, really helpful. Yeah, so we've heard a lot of different case studies, and we've had some great advice from all our speakers. So now we're going to move over to questions and answers. So if you have any questions, please put them in the box. I can see we've got a couple already here. So first question here is one for David and Ruth, asking, what are the challenges and opportunities associated with being the CEO of two companies at the same time, particularly with regard to managing time commitments and building investor syndicates for subsequent investment rounds?
That's a really good question. So there are definitely some benefits. Things that I learn from one of my boards, I can then apply to the other company sometimes, because the different board members I have for the two companies have different areas of strength and things they particularly focus on in terms of either the bigger picture, elements of process or whatever. And that's been very helpful for me. In terms of managing my time, that is quite challenging. I'm not good in having a locus day and then an AstronauTx day, because that's not how the world works. You just need to kind of interleave things. And I guess having worked in large companies and managed portfolios, I'm used to juggling different projects at the same time. So that piece works okay. The biggest challenge is around fundraising. At the moment, I'm out fundraising for Locus 23, and that's going pretty well. But what I want to do is make sure that that's complete before doing any fundraising for AstronauTx, so you're not trying to talk to the same people about two different opportunities at the same time. And it is clear that going forward, I will need to likely go one way or the other, because as the companies grow and develop and we move towards the clinic, then you need to have a leader in place who's fully focused on that company. So it creates some opportunities, but it does also create some complications that we're just starting to address.
I'd add a bit to that as well. I think it's important to recognise that people have skills for particular things. So David, fantastic at being close to the science and starting a company. If you're scaling a business, or if you are selling a business, you may well at that point want a CEO who's got more experience in that phase of a business's life cycle. So it's not unusual to create a company with one person leading it, and then as it gets to the point that it's scaling, bring in somebody else who is much more experienced in that part of business growth. And I think the maturity of business leaders really shows itself when they're prepared to take different roles in the same company or move from one company to another, very often within the same investment organization. So we have CEOs that have been CEOs of several companies sequentially. I think that's part of being an experienced leader in the biotech world. And actually, people coming to the DDF or SV Health investors with experience of several different companies at different stages is actually quite a favourable profile.
Okay, thank you both. That's a really helpful answer. We've got another question here for Ruth, and probably Bernardo can weigh in on this as well, which is an exit strategy something that's crucial to point out in your business plan when you're approaching investors?
Well, it's definitely important to have thought about it. You may not have a well-honed plan. It's definitely important to think through what your options are, and I would say absolutely be able to bring out examples of companies that you think you're like, what their exit has been, what their returns were, a little bit of the history and why you think you're like them. The other part of that is to be really clear about who your competitors are, why you think you will be a more valuable company than some of those. If I were to point out one area where companies come forward and their business proposal is a bit thin, it is usually in the area of really understanding your competitors globally, not in the UK or Europe, but globally, where they are on their journey and why you think you're more valuable. So a really important area to discuss.
Yeah, maybe I can also add 1 or 2 thoughts about it. For us, or for investment from our side, is that when you look at the competitors today, you have a certain landscape, but this landscape will evolve. So I think it's always important to also position emerging technologies. So how would you differentiate your company in the time horizon where you expect to have an exit? So where are you developing, and where do you expect to be in this 3 or 5 or 6 years? And also, as Ruth mentioned, to have a clear profile of what is a company that has been acquired, what are maybe the typical behavior of, let's say, medtech. You would have Medtronic and all these big players. So what is the dynamics like, and position your company there in that space.
Okay, thank you both. Really helpful. Next question is to Antoine. When contacting such a huge pool of potential investors, do you send a company flyer or a brief business plan with non-confidential information, and then when contact is made, sign NDAs and share the full business plan? Or do you share everything up front? And also, regarding valuation, what point should you do your valuation?
Okay, so first, on the contact, you want to basically send a cover email, which gives a very concise summary of your business, and what is a very concise summary of what is the business about, and why it's a good idea for investors to invest in it. So for example, we're talking about exits, that could be a one sentence that kind of catch the attention. With that, I would typically attach quite a short presentation, which would not contain more than 7-8 slides maybe. And again, the goal here is to catch the attention and get a meeting or get a response back. So I think if you do send too much, first, I mean, they basically don't have time. When you talk to investors, they get tens of presentations a day. They don't have time to run through the details. So your presentation needs to be really clear, not a lot of words, really self-explanatory, and hitting all the points that are important to investors. Okay, team, the science, the IP, the exits, the market, 1 slide per theme, and then send that out, and then you can start the relationship and go into more details. Typically, we don't sign NDAs with investors. It's, you know, I think we haven't had any issues with that. You don't want to, you know, basically give all your IP in the first email, but you will have to give some confidential information. But typically it's not, investors have a reputation, so they're not going to disclose your confidential information to other parties. You know, and it's also your job, if they have invested in a competitor company, it's also your job to know that, and at least to ask that, and to say, okay, to have an open conversation about, like, okay, you invest in this company, I'm happy to be open, but, you know, are we agreeing that, you know, there is a kind of a Chinese wall? And then if they say yes, usually you can trust them, and go ahead. So that's the way, that's how we would proceed. Can you repeat the second question, which was about?
Sure. The second question
Can I just
was,
add something to that one, though, because I think there's an additional point. I completely agree with everything you say. But where investors get a lot of things sent through on email, you are 2 steps ahead of everybody else if you can get an introduction to somebody on their investment committee or one of their venture partners through somebody you know. So an email that starts, please be introduced to whoever who is starting a new company called X. I think this is something that you might be interested in, Ruth. Why don't you talk to them? You go to the front of the list. So definitely try and use your network to get you an introduction to either a venture partner or an investment partner.
Yeah, agreed, 100%.
yeah, thank you, Ruth.
There's one other thing I just...
Sorry, David, go ahead.
I was just going to say, there's one other thing that I'd add to that is that I definitely agree with Antoine that from a confidentiality point of view, investors have a reputation to maintain, so they wouldn't share that information. But I use signing a CDA as a kind of first stage gate as to how interested they are. So after a non-confidential pack, hopefully a conversation, if they're interested enough to go into CDA, it gives you some feeling that, you know, that they really do want to learn more. And then obviously hopefully get further along to actually discussion about an investment.
Thank you, David. It's really helpful. And then the second question was, at what point do you do your evaluation in that pipeline that you described, Antoine?
Yeah, so usually evaluation is done at the term sheet stage. Usually you have an idea of what you want. So I mean, there are a few ways to evaluation, right? First is how much, you know, what was the valuation of comparator company? And so you need to have a good friend or someone in your network and say, okay, what was your valuation? Because they won't tell you, a random person won't tell you what the valuation. Now I won't tell you what my valuation was. But so, you know, that's the first thing. Second thing is basically market driven. So if you get several term sheets and investors are giving you different valuation, that's kind of, you know, the range is where you sit, right? So whatever the market is willing to pay is what your valuation is. The third thing is through dilution calculation. So you know that on a typical round, you're going to want to give away 20 to 30% of the company, and you know that the amount of that you need to reach the next milestone. And so you know, there are exceptions to this, but you know, that kind of give you a rough idea of what should be back calculate, what should be your valuation, so you get a reasonable dilution, give a reasonable share to the investors. So I would think that would be the 3 ways to do it, and typically this is done at the market, the term sheet level, but you still have an idea in the back of your head when you go in.
Okay, thank you, Antoine. I think we have time for this last question, so I'm just going to ask the investors on the panel. Can you comment on how investors are viewing new investments in this COVID period?
Should I start, Ruth?
If you like, yeah.
Yeah, sure. So startups in the COVID. So we try obviously to run our business as usual. So we try not to be impacted by it as much as sometimes it seems. So we so there are different kind of startups. So there are startups that profit from the COVID, and there are startups that might be negatively influenced by the COVID. So in the startups that might be negatively influenced, there's things, for example, that some investors might try to handle down the valuation or try to get better terms overall. we as investiere, we try to move us as forwards as usual. We try to pick maybe investments where we see that maybe we wouldn't have a chance to get in, but now they're raising more capital because of the uncertain times. So I think that there are like opportunities and risks, and it's really like important to look at what is the roadmap ahead of the startup if they're negatively affected, and what's their plans to mitigate some risks that they might encounter in their way.
So I would answer that by saying, whenever there is a market shock, the first thing you do is look at your portfolio and ask yourself, what's the impact going to be on the portfolio you already have? So looking at the companies you've already invested in, understanding what their runway is, understanding who's out raising funds, how you need to help them. So number one, look at the portfolio. And as we're talking about the investor-CEO relationship, I think the really good CEOs will already be there in thinking, what's the impact of this going to be on my business? How am I planning to manage it? Let me have a conversation with my investor and share with them how I'm planning to manage it, or if I've got a challenge, they need to know and understand that. So it's certainly for each individual business, it's maintaining that relationship and still continuing to build confidence that as a CEO, you understand your company and you're able to lead your company appropriately in challenging times as well as in positive fundraising times and successful times. So the first thing is look at the portfolio. The second thing is, other than making changes to that portfolio where necessary, which could be providing additional funds, or it could be saying this company was struggling before, it's going to struggle even more now, let's help them sort themselves out. For the DDF, our fund still exists. We still have to deploy that fund. The investors in our fund want us to deploy the fund. So we are still looking to make investments, and we would like to see more successful companies in the area of dementia therapeutics. So that I would say it's three things. It's looking at the companies you support, making sure they're secure, making changes, and it sort of does precipitate changes as any major impact would on a business. Make any changes you deem necessary, and then look to the future by helping to fund the companies that you think are good. And to Steve's point at the beginning of this meeting, Innovate UK, I was previously the CEO there, is going to be really supporting SMEs, and particularly those that have already had funding from Innovate UK. There are new schemes coming forward. So I would say, look to see how you can take advantage of what schemes there are to help secure your business and grow your business. This is a time of opportunity as well as challenge.
Okay, thank you both. I think that's all we have time for in terms of questions. So actually, the question about COVID is a really good segue into me talking about the COVID webinar that the BIA is running this Thursday. There are more details on the BIA website, and if you want to find out more about finance and support available during the COVID situation, I recommend that you join us there. And then all that remains is for me to thank the speakers. I know that there's a huge amount going on in all your lives at the moment, so I'm extremely grateful for the time that you've given us to join us for this webinar, and to thank those who've given up their mornings to watch. So thank you all, and yeah, take care.
Thank you.
Bye.